Welcome to Pointy End. I'm Keith Sutherland. Today my guest is well-known Chief Economist with CommSec, Mr. Craig James. Welcome to Bendigo.
Thank you very much. Good to be here.
Terrific presentation there before, but there's plenty to get through. Now, basically, why is it this country we can't have the tax debate that we should be having? Because we watch what's going on, and I'll talk to you about negative gearing, but we just don't seem to be getting any. Bipartisan approach to politics has gone out the window. So why can't we do it?
Well, it gets down to politics, and then that's the main issue. I think too that there's too many vested interests, sort of pulling the thing apart rather than trying to bring it together. Perhaps what I think we need, something we've had in the past, is something like a tax summit where we can get, sort of all the people, coming together, have a proper debate over a period of say a week, and to put all the proposals on the table. I think too that we do need proposals on the table. It's a full package. So if we're going to talk about an increase of the GST, we've got to talk about cuts in the income tax rate at the same point in time. If we're going to talk about sort of negative gearing, we've got to be talking about, are we going to apply it across all property or some, sort of talk about so all the issues sort of play. So I think we've got to have a comprehensive discussion, and it may be take a tax summit to be able to do it.
So not really a talk fest, we need some proposals to really debate them. I guess both sides of politics need to be able to sit there, work out what the top 5 items are on the tax agenda, and we debate those plus anything else that people throw
and I think we've done that in the past. We did that with the GST discussion. We got a GST so on board. We've done that with other things in the past with tax. I think we need the same sort of thing so in the future. I think too that if we did have a government that had control of the upper house as well as the lower house, the House of Reps and the Senate, then you would get a government that you're able to say, okay, we're going to put this proposal through. They couldn't be sort of a rest on the principle that they were blocked by somebody else, and so it wasn't their fault that it didn't happen. So if we do get this resolution of the Senate ballot paper and we get a reduction of some of the minor parties, perhaps we might get a party with a majority in sort of both houses and be able to push the things through that they need to push through.
On the other side of that, of course, we would have seen the 2014 hockey budget that never made it, but there were some pretty harsh things. Okay, we may have needed it, but there's a lot of people in the public didn't really want that sort of proposal. So anyway, let's get on to the hot topic of the last week, which has been the negative gearing proposal from Labor. We're obviously now waiting for the Liberal Party to come up with their proposal, but what's your thoughts on the discussion? And there's a lot of scare tactics.
Well, I suppose the encouraging thing is that the debate is being had at present, so that's the encouraging thing. It's also a great time to talk about negative gearing because a lot of people are getting into property now, and they're getting into property not with the focus of the tax considerations, not with the focus of, I need to get into property because negative gearing is there. They're getting into property because they know it's providing a return on their assets over time. They're getting a return, and they're investing in an asset which hopefully will appreciate sort of over time. I think it's a good discussion to have. I get a little bit worried when politicians feel as though that they want to just target tax measure to one part of the market, not the entire market, whether you may get some unforeseen consequences coming through. But I think it's one of these discussions that negative gearing has got a degree of emotion which is with it at the moment. I think the longer that we go on with interest rates at very, very low levels, rental costs at low levels, more people going into property, not with the consideration of negative gearing for other reasons, then we are going to see some changes sort of happening. So I'm a little bit positive in terms of the discussion that we've had, but there's a lot more discussion to be had.
Yeah, the other point about it was we need revenue. There's no question about it, that we just need it. At the end of the day, we're looking at tax breaks on investment properties, and superannuation are costing the budget. They're suggesting around about $37 billion a year. We're now seeing a white paper come out tomorrow, I believe, where they're going to spend 2% of GDP on defence. They're talking about having 12 new submarines. It's been suggested by Andrew Wilkie from Tasmania that we can't even have enough staff to the 6 submarines that we currently have. So maybe we've got to cut back on some areas, but there's certainly been plenty of benefits for negative gearers like myself and other people. But how do we get extra revenue? Because that seems to be the biggest problem.
we need a total change in the tax mix. So what we need to do is we need to increase the GST. That's our view, is that the GST is too low. Other countries around the world, so have got much higher levels of GST because they've had the right debate, so down the track. We do need to move up to at least 12.5 or 15% for the GST. But what we also need to do is to cut the top income tax rate. There's a number of things over time which we've got to address. One is the ageing of the population, the need to keep people in the workforce. That's important, as well, and to be able to pay for the health expenditures, the expenditures which naturally come with the ageing of the population. So I think what we do need is the GST to go up, the income tax rate to come down, the business tax rate to come down. We need less attractive measures in terms of superannuation tax. We need to reduce some of the attraction about negative gearing as well. We need a holistic and sort of package of measures to be able to address all the issues which are on the table.
Okay, I read your report from last year and your outlook for 2016. Interesting, you've got unemployment, you suggest somewhere 5.5 to 6, we're a little bit over 6 at the moment. Interest rates, cash rate for 2015 averaged about 2.11%, and you're suggesting 1.75 to 2.25. So you're obviously suggesting by that we're going to see a couple of interest rate reductions this year if you're saying 1.75 to 2.25.
Yeah, we certainly believe that the Australian economy will pick up momentum as the year goes on. So we do have low interest rates at present. We do have growth happening in the economy. The housing market is driving the economy forward. I think businesses are slowly getting more confident. Their company results that we've had sort of recently have been very, very good. And if that continues to occur, then we are going to continue to see businesses starting to put sort of the dollars to work. Where we are seeing the job growth at the moment is in the services sector, and that's so very encouraging sort of present. Areas like so health and cafes and restaurants, and the Reserve Bank's been a little bit surprised by the unemployment rate falling, but basically it's the service sector which is basically driving those sorts of gains. In terms of interest rates, well, we don't see the need for interest rates to be cut. But we acknowledge what the Reserve Bank is saying, that if there were to be a change in interest rates, it's still more likely to be a rate cut rather than a rate hike. For the simple fact, inflation's under control. That provides us with a degree of flexibility. And if there was some flagging momentum in the domestic economy, perhaps some jitters from abroad that we need to respond to, we have the ability. We are in a position to be able to cut interest rates where we are. So 2% cash rate, we think it's going to remain in that case for the entire year. But if there is an outside risk, it's the cash rate getting down to 1.75%.
The other volatile part of the market, and we've all seen it from the start of this year, the share market. Having watched your slides earlier today, in that presentation, we're on line with the long-term average, and we only look at it. You also made the point, don't look at it daily, which most investors do, but we look at it on the weekly basis, daily basis. But at the end of the day, do you see that sort of stabilising a bit, or is oil going to be the real bugbear out there in the system at the moment?
I think we're starting to see signs that the oil prices are bottoming, and bottoming around about $30 a barrel. I think that we've reached the pain point for a lot of the oil producers, that at these sorts of levels, oil producers say, look, we don't want prices to continue to fall. At these sorts of levels, around about $25, $30 a barrel is perhaps where they need to stay. So Saudi Arabia and Russia, Iran and Qatar, amongst some of and Venezuela amongst those countries which are suggesting that we need to restrain production to the January sorts of levels. I think that will, provided sort of we get a little bit more of agreement, sort of, and countries abiding by that, then we are going to get some stabilisation in the market. And that takes away some of the uncertainty, sort of in the markets. You take away uncertainty, and you'll get more investors putting their money to work in terms of the share market. So At the moment, the Australian share market's sitting around about the 5,000 level. We think by the end of the year could certainly rise 10% to around about 5,500. So we see growth over the year, not huge sorts of growth, but we do certainly believe, sort of it's sustained by the fact that companies are reporting good earnings at the moment. They're providing dividends, they're providing returns to their shareholders. And I think as we go through the year, we're going to see fewer people wanting to put all their money in the property market, and some of those money saying, look, we'll put some in the property market and some in the share market. So I think some of the dividend yields that are on offer at the moment, in the share market are quite attractive, particularly sort of for the likes of insurance companies, banks, and even telcos like Telstra.
Okay, you mentioned the housing market, and that's something that's been driving this economy. That's leading the way, obviously, with our growth, and that's why we're talking about negative gearing, we're talking about lots of other things. You also put a slide up there which was interesting on Bendigo, and you and I discussed why Bendigo prices were up there, the growth, the development, and they were actually building approvals. We've actually come down because we've got a brand new hospital that'll be up and running from 2017. But Melbourne, we saw 11%, Sydney 10.5% growth. What's your prediction for the future with those sorts of areas? Because we're probably levelling out, I would have thought, with the growth that's happening. And you also mentioned unit development seems to be the new normal rather than 3, 4, 5 bedroom houses.
Yeah, I mean, housing is fundamentally quite simple. It's all about supply and demand. And in markets like Melbourne and Sydney, sometimes they do fall out of whack, where you get some demand running ahead of supply for a period of time. Supply starts lifting up and then ends up going to an oversupply situation and then starting to balance. In the rural and regional areas, we tend to have greater balance between supply and demand. That's why we have less volatility in terms of home prices. So I think what we are seeing is Melbourne and Sydney prices have lifted in significant terms relative to other capital cities and also relative to the regional areas. I think over time we're going to see the regional areas and other capital cities drift up to where so Melbourne and Sydney stand. So they'll play catch up, but so probably in a long sense rather than sort of return to jump up quite quickly. You do get developments, so like the hospital, sort of here in Bendigo, and that's going to create jobs. And if more people come to the region, that's going to create demand for houses. And that's why we should watch those sorts of things, sort of, and always ask the so what question. So, well, hold on, there's a new hospital coming. That creates demand for health services. It creates doctors and nurses and physiotherapists, cardiologists, you name it. Sort of, they all need somewhere to live. They've got dollars to spend. That creates even more momentum for the economy. So certainly, so that will be something to watch out for, sort of over the next couple of years.
Finally, with the superannuation, and that's been a big topic, obviously, Barnaby Joyce came out and said, well, perhaps lower income earners don't need to put money into superannuation. That's the first question. The other part, where do you see it? Because you also mentioned before, as people get older, they want conservative investments. Where do superannuants go and what's the best investment for them? But firstly, the Barnaby Joyce situation, because to me, I thought it was a silly idea, but anyway, that's what he's come out with. I don't know if it's policy or Barnaby's just putting it out there, I'm not sure. Yeah,
I think we should remain focused on the longer term, and the whole idea of compulsory superannuation is because we do have an ageing population. We want people to fund their own retirement. In future, we're not going to have the number of people in the workforce to provide the income sort of that we need. We need and be able to provide pensions. We will in the future wanting to have people to provide for it themselves. And of course, when we think about pensions and when they were introduced, in the early 1900s, people didn't live to 80, 90, sort of 100 years, so it wasn't, sort of a big issue. Now, of course, people do live to 80, 90, 100 years, and if you were going to provide a pension for that period of time, it's going to have significant constraints on the public purse. So we do need people to provide for their own retirement, and I don't think we should start creating exemptions for superannuation, those on part-time workers or low paid, so not providing it. I think everyone should continue to see that compulsory superannuation being provided for them. In terms of those people who are in superannuation wanting to get a return on their assets, I think the old adage of not putting your eggs in one basket always holds. you're going to get a return on your money in the property market and getting that rental return coming through. Perhaps in terms of commercial property, perhaps in terms of infrastructure, the share market, in fixed interest, online cash deposits. It is harder to generate a return, but remember, with inflation low, you haven't got to generate supernormal type returns. You just got to get above inflation, so you're staying ahead. And with inflation around about 2% or a little bit below, you don't need huge gains to be able to stay in front. I suppose at the moment you look at the dividend yield on banks, fully franked, up around about 6 or 7%. You haven't got to pick the banks as well. You could just basically set the top 4 and a couple of the regional banks, put them all together. Over time, that's going to provide you with a good return on assets. But of course, you shouldn't just be investing in banks. That's just an example of the sorts of returns that you can get in the share market, and supplement those with returns from other assets.
Well, Craig, really appreciate having the expert. Well known, you're always up there when we're talking about interest rate, Reserve Bank changes, etc. It's great to have you in Bendigo today, and I really appreciate you appearing on the pointy end, giving us your details of where you see it. And as Chief Economist with CommSec, really appreciate you talking to us today.
Well, thank you. It's certainly been my pleasure to be here.
Thank you.